No comments? Everything looks good? Okay, let's move in. I got an interesting article here for us. So this is a piece from Business Insider. It says unknown market wizard, Peter Brandt. Now, right there, he is a very known market wizard once you're in the trading space. But the reason why they gave him that title in this article is because in Jack Schwager's new book, Jack Schwager, however you say his name, Peter is the first trader in the book titled Unknown Market Wizards because Jack interviewed people that are just less known. But if you go to Peter's Twitter account, he's popping. Peter's a really smart guy, and I've read a lot of the articles and studies that he's made commentary on. So to me, not an unknown market wizard, but to some of you guys, you may never have heard of him. Peter Brandt is definitely one of the top 10 traders that I would recommend you study. So it says here, he averaged an annual compounded return of 58% over 27 years. The highly profitable trader breaks down how he finds asymmetric opportunities and shares 2 rules to avoid popcorn trades. Popcorn trades is something that you've probably heard me say before. This is where I got it. I got the term from Peter. He taught me how to avoid popcorn trades just from studying his successes and his failures. The beautiful thing about some of these like trading legends is that they share so much of their success and a lot of their failures with us online and through their books and through their blogs. Those failures are huge lessons that you don't have to take big losses to learn. You can read and study what they've gone through and then avoid it. Awareness is the key, just like we were talking about earlier. So it says here, some legendary traders are born. I don't really think so. Others are made. That's what I believe. Peter Brandt is inspired. It says Brandt, who grew up dirt poor, was already working at one of the largest advertising agencies in the world when he met a fellow friend, a soybean trader, for lunch at the Chicago Board of Trade. Now, this is back in the day where you had floor traders, like the pit, the guys are screaming and they're, you give me this, fuck you give me that. Like, you know what I mean? They had their own hand signals. This was just a different time. We were not sitting at desks like this trading. Retail trading was not a thing, right? Immediately, the open outcry trading pits captivated him. That's what I'm talking about, these pits. You can look that up if you don't know what the trading pits are. Brandt, who is profiled by Jack Schwager in his new book, like I just said, went on to have a trading career that includes a 14-year span starting in the 1970s and then a second span that started in 2006. So he traded for a 14-year period starting in the 70s, stopped trading. I forget what he did. In the book he explains it. And then he came back. Over almost 3 decades, he averaged an impressive annual return compounded of 58%. But when he first started trading in 1975, Brandt was getting frustrated about finding a methodology that would work for him. Sound familiar? He tried point and figure charting, seasonality patterns, spread trading, but it was not until he learned how to use protective stop losses, and read the book from Robert Edwards and John McGee, Technical Analysis of Stock Trends, that things finally turned around for him. He said that it gave me a framework for understanding price. It gave me an idea of where to get into a market. And it also gave me a way to establish where to protect myself on a trade and an idea of where the market might go. Basically what he's saying, understanding how to properly use stop losses prevented him from not understanding risk. It gave him an understanding of risk. The so-called Bible of technical analysis brought Brandt into charting. In 1979, he was well on his way to trading success. The following year, he incorporated his firm, Factor Research and Trading. It says from analytical chartist to meticulous risk taker. Now, in my mind, I put Tom Basso and Peter Brandt kind of in the same boat. Both guys preach now about understanding your risk, riding trends, and moving your stops up. You're going to get some details here in a second about that. It says chart patterns are no longer essential to Brandt's trading because they are subject to failure and could morph into another pattern. Peter is also the guy that I give credit to for teaching me about the unreliability of triangle patterns, of diagonal trend lines, how often they can be faked out and then moved against, more often than horizontal lines. So I've really gotten away, you'll see in my trading, if you watch my videos, you watch my streams, I've gotten away completely from trading pennant formations or anything like that. I look for horizontal zones, horizontal price levels, not one price, oh, it has to stop at this price. Never. It's always a zone. There's order flow coming in from all over the world. It can never just be one price. It's a block. It's a pin. It's a wick. those are where we find the best horizontal zones. Yesterday's high, today's high, high of week, those significant levels right there that I just gave you, if you want to write those down, those are the three that I really am focused on. Let's keep going. It says as charts became much less reliable than they were during the 1970s and 1980s, Brandt switched from trading 1 to 4 week patterns to trading 8 to 26 week patterns. So he's a swing trader. He also became more selective and would only trade patterns where the breakout is through a horizontal boundary. Didn't I just say that? Which allows traders to find out much more quickly whether they are right or whether they are wrong. Over the years, Brandt has incorporated protective stops into his trading methodology. He said, yes, the risk I take on a trade is much lower now. Whenever I take a trade, I limit my risk to about half of my equity from the point of entry. I want to have my stops at break even or better within 2 to 3 days of entry. Now, for those of us like me and you, a lot of you guys, we're day traders. We're not going to be locking our stop in 2 days. I'm going to be locking my stop maybe in 2 candles, you know? Just a different time frame. So the methodology is still there. I want to lock stops, but I'm not going to try to apply the same exact technicality because he's holding trades for weeks, and I'm not doing that. Brandt had his first bad year as a full-time trader in 1988, losing about 5% after being up 600% the year prior. By 1992, his trading was trailing off. He traded his own account for another 2 years before closing it. The fun of trading had just left me, he said. Trading had become drudgery. I was feeling the discrepancy between how I was performing and how I knew I could perform. That gap was emotionally difficult for me to live with. I totally understand that. Asymmetric opportunities and popcorn trades. In 2006, Brandt makes his return to trading after an 11-year hiatus. It's like Batman coming back. He was gone for so long that the world had transitioned into electronic trading, but his trading strategies and rules still applied. In fact, when he deviated from his trading rules in 2013 and started adding mean reversion trades, which allow traders to sell on strength and buy on weakness, he suffered an 18-month drawdown of 17%. I had bought into the lie that I had to change because the old ways no longer worked. I finally realized I just had to get back to basics, is what he said. And after that drawdown, Brandt started looking at his equity based on closed trades only, which I've always been a big believer in. Also, he said, once the profits of a trade equal 1% of my equity, I take half the position off. So just a similar but different way of managing his risk to what I do and what I teach. For me, I manage my stop loss and I take profit based on risk multiples. He's doing it based on a percentage of his overall equity. It's very similar, just slightly different. And it's a different market too. He was trading stocks and futures. I'm trading Forex. Another rule he instituted is to raise the stop once he gets more than 70% of his profit objective. He said, if I have an open profit of $1,800 per contract with a target of $2,000 per contract, why would I risk giving it all back to make an extra $200? So simple. But some people will do that. They will not lock their stop losses. People will argue and they'll say, hey, you got to have your full stop, full take profit, hold the trade till it hits one of those. If it works for you and you're making money, I'm never going to tell you not to do that. I'm going to tell you what Peter did, what worked for him, and what works for me, and what works for Steenbarger and Bellafiore and a lot of these other guys. They're all saying the same thing. But then you got these guys on Instagram that are like, take the entry, add to the position, don't move your stop, hit full take profit, or get stopped out. Be a man. No, bro, that's not trading. Mitigating risk, understanding risk, and taking profits. Unrealized P&L is not P at all. It's almost an L, in my opinion. If it's unrealized, it is not worth counting. Let's just keep going here. By abiding by these two rules, he avoids making what he calls popcorn trades, which are profitable trades held for too long to the point where the entire profit is surrendered or turned into a net loss. It shoots up 1R, 2R, 3R, you risk 10, you're up 20, you're up 30, you're up 40, boom, it's back down to break even because you didn't move your stop loss and you're still stuck in that. Oh, boom, now it's going towards your stop loss. You were up 40 risking 10 and you somehow lost. That is unacceptable if you're trying to build a trading business for the long term. If you're trying to just gamble and make money and you're focused too much on the money, you might risk 10, go up 40, you might be going for 50, and because you're greedy, you stayed in the trade and now you got nothing. And that's a popcorn trade, and that's why I avoided them ever since. I mean, I think I was already avoiding them because I've always used stop losses, but the mitigation of the risk really came to me after I heard Peter talk about it on Twitter. Instead, Brandt looks for asymmetric trades where the perceived upside potential significantly exceeds the required risk. That word asymmetric potential, where else have you heard that? Paul Tudor Jones. That's like his famous quote. He's always looking for asymmetric risk, 6 to 1, 7 to 1, 8 to 1. That's where he's looking. He tends to find these opportunities near an ice line, which is a price area that is difficult to get through, but should provide support once it does. An ice line is a horizontal level. Start using that term if you'd like. Yesterday's high is the ice line. Once I'm above the ice line and its resistance then turns support, then we're looking to trade. That's a much more solid trade, as we talked about today as we went through the watch list, right? And lastly, if I can find a market with a price breakout where at least half of the day's range is below the ice line, then that low can serve as a significant risk point. Basically what I just said, breakout, retest, using that initial bottom or top, if you're going short, using that initial point as the stop loss, as the risk point, and then moving it as the price action continues. So I just thought that this was a great article to share. I'm a big fan of Peter. I hope you guys go check him out. I would check out the Twitter. I would check out everything you can from Peter. And if you haven't read Jack Schwager's new book, Unknown Market Wizards, I would definitely recommend picking that up. Kindle, Audible, Amazon, whatever you got to do. I know all three of those are Amazon, but you get my point. You want the hardcover, you want the Audible, you want just whatever. And even if you go on YouTube and just type in Unknown Market Wizard summary, I'm sure people have made summaries of the book and they can give you a little taste of it before you get it. But really, and I was thinking about this yesterday, where do we feel that we grow the most as traders? I'm curious to know, what do you guys think? Where do you feel you grow the most? For me, it's either in chart markups, studying my charts, maybe testing a new idea, or reading books. I don't really get any value anywhere else. Videos are great, but the retention of the knowledge in a video is very tough. Where else do you learn? Where else do you literally read something, feel like you're getting value, and then boom, you just downloaded new information to make yourself smarter? It's reading. So don't turn away from reading trading books, and really don't turn away from reading psychology books in general. Learn how you think, and you'll be able to control those thoughts more. Cool?